The Chinese darling of Wall Street, Alibaba Group, just reported earnings yesterday, and boy, was it not good. So today we're going to analyze the stock, and we are going to find out if now is a good entry point to invest in this company. The market's poor reaction to Baba's earnings caused the stock to close down over 9% in one day, largely based on the company's revenue miss, and as we'll get into, the fact that the company is no longer divesting out of a few of its different segments. Even though the company beat on its earnings by 5 cents and its earnings rose by 21% versus a year ago, revenues only rose by 8.5% to $30.81 billion, which was below the consensus of $31.04 billion. This is an issue because the company is basically stuck at $30 billion in revenue over the past 3 years. Being a growth stock, Alibaba needs to continue growing that top line. Otherwise, investors are going to get suspicious and no longer expect growth from the company. As a bit of a sweetener to hold on to the stock, though, management did initiate a $1 dividend for all of its ADS holders. If you own this company in the United States, then you hold its ADS shares, not its regular shares, which are traded in the Chinese stock market, and that would be close to a 1% forward dividend yield, so not terrible. So for anyone not familiar with Alibaba's business model, they are kind of like the Amazon of China. They have a main retail segment that sells stuff mostly online, and then they have a variety of different other revenue segments, including a shipping business, a cloud business, etc. And one of the things that Alibaba has been talking about doing is breaking off some of their different segments in order to focus on bringing back revenue growth to its retail business, among other things. With its Q3 earnings report, Alibaba announced that it's not going to spin off its cloud, and they did this citing chip restrictions that the US has put on China. I'm not sure if that is a excuse or if that's the actual reason, but for me personally, I view this more as Alibaba needs to continue to have some revenue growth, and they understand that their revenue growth is probably going to come from their cloud much more than it is from their retail business, and so they see the writing on the wall, and if they spin off their cloud, then their retail business is going to suffer. The company also announced that their Alibaba Fresh Shippo grocery business is also on hold to spin off, so the company really just canceled all of its spinoffs. It's trying to hold on to as much revenue and as much earnings as possible. And to shareholders, that means two things. One, the company might just not have confidence in either the businesses that are being spun off or the core business that will remain. And two, Alibaba is going to remain this conglomerate and they're not going to be able to focus on streamlining the revenues that do remain. And so it's just going to stay in the same sort of position, spinning its wheels and going nowhere as it has for the last couple years on a revenue basis. And before we get into the financial numbers, please take a moment to like this video and subscribe to my channel. It means a ton to me. And with that, let's get into it. Alibaba's revenues have grown substantially since 2018, up 22% year over year. But as we can see, the company has really gone nowhere since reaching its peak revenue in 2021, and the number continues to fall slowly over time. EBITDA does look better. It has stalled quite a bit since 2020 and there hasn't been much growth, but at least from 2022 to the trailing 12 months, the company is appearing to return to some sort of growth. Operating earnings, on the other hand, are still stagnant and still falling from its 2021 peak. Combine all of this together and we see that the growth story for Alibaba has at the very least hit a major pause. Annual gross margins have fallen from 46% in 2018 down to 37 or 38% in the trailing 12 months. Some of this has to do with expansion in Alibaba's businesses to more things like the cloud and to their shipping and other negative earnings generating businesses. But in general, this is not great to see. Operating margins have shown a bit more resilience, but they are still down from their 2019 highs and have yet to normalize to pre-2020 levels. Return on assets show much the same, with a major dip in 2021 that is starting to reverse and can hopefully go back to expanding as it was before 2020. Baba's shares outstanding were growing for a little bit between 2018 and 2020, but since then, the company has been buying back its stock at a somewhat decent rate. It's not uncommon for a lot of foreign companies to never buy back their stock, so it is good to see that the number of shares outstanding is falling for Baba. The company's cash and short-term investments have grown substantially, which is really good to see, especially considering the possibility of some major economic downturns in China. The company's long-term debt has increased a little bit, but it is a totally manageable number for Alibaba, and it really has gone nowhere since 2020. So even with the 7% increase in debt outstanding, the company's revenue and earnings growth has easily been able to cover that. But even with its ballooning cash balance, Alibaba does pay a small amount of net interest expenses at about $1 million per year. That's really insignificant for such a large company. So like I said, I'm really not worried about its debt situation. The company's free cash flow has grown by about 4.75% per year, which is pretty good to see, especially for a very large retail company like Alibaba. There was a major spike in 2020 followed by a deep drop in 2021, but Alibaba has been able to return to its pre-2020 levels and does appear to be expanding that free cash flow at a slow but steady rate. On a per share basis, Alibaba is much closer to reaching its free cash flow peak, so I really have no complaints here either. And as I said earlier, Alibaba did just initiate a $1 per share dividend. I don't have any dividend data here because that dollar per share has not been paid out, but it will be interesting going forward to see how much that dividend payout does grow. And so moving to the value chart, we can see that Alibaba is below its fair value PE of 15 by a pretty significant manner. I have its fair value calculated at $119.10 versus its current closing price of $87. As a quick note, my numbers update at the end of the week, so this doesn't show the about 10% plunge in Alibaba's share price, so the deal is even better than I'm currently showing. But what I would like to point out is that its fair value has shrunk quite a bit in the last couple years, going from $150 down to this $120 number. And its projected annual growth rate is only 1.65% per year. So there's not a lot of growth expected from Baba, which is one of the major reasons why this company has crashed from over $300 per share to now being under $100 per share. At this expected growth rate, in 2024, the company is expected to be worth $121, in 2025, $123, and in 2026, only $125. Now, from today's price on the open market, you can still get a very good return going up to $125 by 2026, but you have to wonder if the growth will actually be 1.5% or will that number continue to come down? Because if we looked back at Alibaba just 2-3 years ago, the expected growth rate was much, much higher. Although there is also the potential that the growth rate reaccelerates and you're getting an exceptionally good deal right now. So the question really becomes, how much do you think Alibaba is going to grow into the future? So in a final review, what I like about Alibaba is that it has excellent valuation multiples right now, which represents what is probably a good deal for your money. The company also runs a pretty monopolistic business model. Like I said, they're similar to Amazon in that they're kind of a one-stop shop for a lot of online purchases. And so I do see some safety in this company just based on the fact that it has such a wide moat. And finally, the company is very financially healthy. It doesn't have much debt to worry about. Its debt payments are very low and its free cash flow is quite high. So from a balance sheet perspective, Alibaba is really great. Moving on to what I do not like, number one, first and foremost, is the political risk of owning a Chinese company. We all know, or at least I hope we all know, that China is a communist country. And while it is not my job to tell China how to run its country, there is a pattern of the Communist Party really controlling certain aspects of the Chinese economy, which essentially leads the government to picking its winners and losers. So if Alibaba was to get on the bad side of the Chinese Communist Party, then we could see the business just basically evaporated overnight. In fact, if you are familiar with the company's founder, Jack Ma, he did speak out against the government and has kind of disappeared ever since. I mean, he's not totally disappeared. He did disappear for quite a while. He's back in the spotlight, so to say, but he has been removed from leadership of Alibaba. And so I think that is just kind of a warning that you need to be aware of, that the Chinese Communist Party operates differently than most Western countries, and they do take a lot more control in their economy. Secondly, the Chinese economy is slowing down big time. A lot of this is in their real estate sector. And as we saw in the United States and around the world, if real estate goes down, there is a huge potential for the rest of the economy to come tumbling down with it because consumers just cannot afford things. Consumers might default on their debt, etc. So that is something to keep an eye on and be aware of, because obviously if the consumer in China is making less money, then they're not going to spend as much money at Alibaba. And finally, I really need to see these margins start to expand again. It's never a good sign to see consistent falling margins. It either shows that the company's economic moat is eroding and they're no longer as protected as they used to be, or it shows that the company is needlessly spending money in places that it really shouldn't be and the business is just getting bulkier than it needs to be. So for my final thoughts, Alibaba is an excellent company, and if I was to invest in any company in China, it might be Alibaba. But with that said, I personally see too much political risk in the Chinese system and the Chinese economy, so I like to avoid Chinese stocks just on a general basis. That does not mean that I don't think you should invest in Chinese stocks. Your investment decisions are always completely up to you and should not be totally informed by what I say. And if you do buy Alibaba stock today, I think as long as there are no major economic or political risks that play out, this company could be an excellent investment for you. So as always, that's my 2 cents. It's not financial advice. And really quickly before you go, can you please hit the like button and subscribe to my channel? I would love to keep making videos like this for you. And with that, I hope you guys have a wonderful day.